Ganeshaya Namaha. Let us continue our retirement planning sessions, and during this session we'll see how to earn 11% return on investment and what is the best asset allocation. Investments are associated with risks of losing the principal even. One may feel that bank FDs, post office monthly income and other schemes are risk-free. That is true, but one cannot beat inflation with these, and then comes RBI, Reserve Bank of India bonds and government securities. These are slightly better than FDs, yet fall short of inflation protection and growth. Then comes low risk corporate funds, corporate bonds and non-convertible debentures. In this, one can allocate a small percentage of total investment with the aim of achieving overall 11%, which is beyond the reach of these above alone. Then comes again in the low risk group, mutual fund, debt funds, mutual fund, debt funds, also equity linked tax saving ELSS. Generally, these funds yield around 9 to 11%. Thereafter, medium risk mutual fund equity funds. These generally allocate about 60% in equity market and balance in debt market and G securities. Then, above all, high risk stock market, which can yield astronomical results with a high risk of losing the entire principal even. When I say stock market, I mean long-term passive funds and not day traders. Within the stock investments, there are sectorial, small cap, mid cap, large cap, etc. We will not discuss about these in detail, as I finally am going to recommend my viewers to consult financial advisors, portfolio management services and tax consultants. I am a mini school investor, and at the age of 74, I have following asset allocation and returns as per the table below, with huge percent on fixed income category of Prime Minister Vaya Vandana Yojana, Senior Citizen Savings Scheme, etc. My 3 years performance as on date is equity fund 28% allocation, which I got a return of 20.31%, 20.31%. Mutual fund equities, mutual fund debts not fund negligible, 15%. Mutual fund equities, 15%. This could generate me an income of 10.95%. There comes fixed income, and this is about 57%. And this has given me a return of 8.3%, and in overall I got a return of 12.30%. The idea is to show that 11% return is practical. For persons of age 30s and 40s, a probable asset allocation could be as follows. In risk-free investments, FDs, in NPS, in new pension scheme, PPF, etc., 10% allocation, which can give a return of 8% Low risk category G-SEC, corporate bonds, etc. can get around 7% to 9%. Allocation is 5% each. And then again in low risk category, mutual fund, debt funds, about 10%. This can generate a return of about 9%. Medium risk mutual fund equity funds, about 30%, which can generate about 13% in return. High risk stock equities, about 40%, and this can generate approximate return of 20%. Overall, one can achieve an approximate return of 12%. Of course, there are other tempting options like insurance-linked pension, such as ICICI's Lifetime Super Pension Scheme with IT benefits. These generate wealth at a rate in par with mutual fund equity funds, but one will fall into the trap of low-yielding pension for your anticipated 25 years of retired life after vesting date at a meager rate of 6% return, which will be insufficient to fight inflation, that too at old age. The author has done a case study of one of such plan and available in his website bnvenkat.com. Let us see about the best allocation in different risk category. Best asset allocation depends upon various factors such as one's age, goal, risk appetite, etc. One should certainly seek the help of financial advisor, SEBI approved, portfolio management service, tax consultant, etc. Many financial advisors provide all under one roof. Financial advisors suggest in such a way the scheme most suitable to you, and after the fee for their services, make you to earn as much as around 14% return overall. I hope the viewers now get confidence that they can earn over 11% return, the assumption taken in our retirement calculation discussed in previous session. Let us now move on to next assumption of 6% inflation protection. Cost inflation index. We can calculate inflation percentage cumulative over the years since 1981 from government supplied cost inflation index CII from their IT department. There is old CII from 1981 to 2015 and new CII from 2001 onwards till current 2022, that is 2022-23. Yeah. The author has correlated these two Google Sheet and arrived at the desired cumulative inflation in the Google Sheet. As per this, the cumulative inflation percent for 42 years up to 2022-23 is 6.67%. We can have a look at the G sheet. How to calculate cumulative inflation is cumulative inflation percentage is equal to A divided by whole to the raised to the power of 1 by n, A divided by B whole raised to the power of 1 by 1 minus 1 whole into 100, where A is the current year CII, P is the base year CII, and n is the number of years, which is current year minus base year plus 1. The old CII is base year is 1981-82 is 100. The new CII base year is 2001-2002 is 100. And correlated CII for year 1981-82 is 100. The CII for current year 2022 is 331 as per new CII, and the correlated comes to 1410 to the base year of 1981-82. Let us see the full chart. Full chart goes like this. World cost inflation index are available from 1981-82 up to 2015-16. Then comes new cost inflation index 2001-2002 onwards up to the current year of 2022. This varies from 100 to 331. See, 426 of 2001-2002 old inflation index is old cost inflation index of 426 is just equivalent to 100 in the new CII, and the correlation continues. Cumulative compounded inflation percentage since 1981-82 is worked out and available here, and the current year inflation is 6.67%. Current year cumulative inflation for 42 years is 6.7%. Even though the inflation, even though the cumulative inflation has gone more than 7.5%, 7.6%, etc., but year on year, year over year index had gone to more than double digit in about 4-5 years. Yet the cumulative index is less than 7% now. I do not have any political inclination, yet I would like to mention that since 2014 onwards, the inflation index, inflation percentage, is steadily decreasing from 7.3% to 6.67% in Modi government. Even though many economists say the economy is in bad shape, the government CII story tells the reverse. Let us continue the discussion in the next session. Thanks for watching. Venkataraman.